Take a look at this big move down. Boom. Everybody would like to be short up in here because it immediately goes down and goes down pretty fast. Is there anything objectively get you short up there? And you want to be bearish. And if you are bearish, you could see our laser goes red to green, which is bearish. Boom, right there. The laser right there goes green, which just means more shorts to more longs now. And then our chaser goes to a nice sell imbalance. Let me back it up so you see it. Just look at these numbers to make it simple. Right in here, it's balanced 580 by 493. Balance, 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 balance. Just keep watching these numbers. As soon as it flips, right 5 to 3, boom, right there. Right there. And I'm going to pause it. It shows that the sellers are starting to take over. And those who want to sell versus those who want to buy are favoring the sellers. You already, right before that, went more shorts in the market. That's this red line. To more longs in the market. That's this green line. So red to green is bearish. So there are objective things that get you short. But then here, take a look at right here at the bottom. Market slides lower. And then you get these little green profiles here showing you sell stop orders, sell market orders that originated as sell stops. And most sell stops are used to cover a long position for a loser. So then you therefore could say longs puke right there. And there was a big sell order. This in real time would get you to say this would be a temporary bottom. If you're short, cover in here. Because it's probably at least going to, if it's going to go down, it's going to go sideways for a bit. In this case, it bounced. It found a bottom because you shook out longs. You need a lot of longs for the price of anything to go down because longs become future sellers. If you have less longs, you have less future sellers. And that's what this is. 659 contracts were exited. Longs were exited. Therefore, longs puke. So the market and price has got to reset and attract more longs in order to go down again and have the dynamics needed, the ingredients needed to go down. And you could see the market bounced. So if you were short and you covered down in here, or you were aggressive and you were bullish looking for a bottom, and you made the prediction based on the chaser was going to flip, sell to buy, but all these longs that puked, and a sell market order gets rejected, and the laser is going to get, you see all these shorts that come in here, they're going to get stuck at the bottom. Now you make a prediction that this is a temporary bottom, and then it is, and it doesn't feel like a good guess. When your predictions don't feel like guesses, now you've got the right information and the right tools. You're not guessing. But most people, when they trade, they feel like their winning trades are just good luck, good guesses. Well, there's not going to be any consistency that follows that unless you're making predictions and they don't feel like a guess. And so the market does, in fact, rally up. You get all these shorts stuck in the hole. So instead of being one of these shorts that actually take a loser, you could be on the right side, get short higher, or pick a bottom and at least have a little bit of a head start. But you got to look at two things. That's other people's positions and buyers, future buyers versus future sellers. And it's not just the accumulation on your dome. Look at the two numbers and have your dome or software add those two numbers. That's not what this is. Because a lot of those numbers and everything else is all bullshit. These orders are getting moved around. There's another criteria added that creates these numbers that make them not just more accurate, but the comparison of them is what's most important. And when that comparison changes, when the delta of buyers to sellers changes, the value, the edge, the advantage in any predictive model, whether it's the weather you're predicting or stock prices or futures prices, the advantage is always going to be when you can identify a change and be at the beginning of identifying the change. So it's if it's an economic data point that you get early, huge edge. If you're friends with someone in the Trump administration and they call you up and say Trump is going to do this 90-day pause when all the volatility around the tariffs in early April were happening, that's a huge edge, right? You're getting a change and you're getting it early. Now, those are things you're not going to necessarily get, but changes in order flow, changes in the things that make price move, the relationship between people who want to buy it versus people who want to sell it. Also, knowing other people's positions is giving you insight into the future because people who are long are going to sell it at some point in the near future. Why? Because they got to cover that long position and exit it. People who are short are future buyers. Do you see where the value is by knowing other people's positions? Because it's giving you insight as to what's next. Longs are future sellers, shorts are future buyers.